Thank you, Kevin. Good evening, attendees. We appreciate you taking some time out of your evening today to listen to our presentation. Thanks, Kevin, for starting things off. We appreciate that. Let me just get my my screen in order, and we'll fire away. During the course of the webinar, we'll be talking about several commodities. We'll be talking about an investment in those commodities. So just to make sure that our confidentiality notice is on the screen, this message really is more of an educational message today, not a solicitation of an offer to buy any security or any interest in any fund. That can only be made through a private placement memorandum. And so today's basically educational. Myself and my new business partner at Terrafort, Alan Romero, will be hosting the hour. I'm the CEO of Precious Timber. Alan is the CEO of Terrafort. Today's message is basically a wealth message, a wealth preservation, and a wealth legacy message. And over the last 12 or 14 years, since I've been in this agricultural space, I've been amazed at what I have learned, the meetings that I've been privy to with some of the world's most premier investors, certainly very wealthy families, and learned a lot about how various portfolios are structured. And I want to share some of the things that I've learned over that 14-year period with those of us on the call today. Of course, when we're talking about wealth, if you know any of the statistics, it's generally here today and gone tomorrow. What I mean by that is, did you know that the first generation generally makes the money, but rarely does it ever pass through and stay in the family? Just a very tiny percentage, actually, a very small percentage of families are able and capable of holding on to the money. In fact, 70% of most families' wealth is lost by and during the second generation, and more than 90% of family wealth in America particularly is lost completely by the third generation. Now, as you can see on the screen, there's some very famous faces. I just put this montage together because these faces are all individuals that made a really amazing amount of money, but they went not just from rags to riches, but from riches to rags. All of them have either at least once, and some of them many times, been bankrupt and lost their entire fortunes. Part of that reason, of course, is some of those people for Hollywood individuals, and it seems like more and more people are living for today and are not really planning for tomorrow as much as maybe the older generation did. And so, of course, the toys and the houses and the jewelry and the shopping and even some gambling gets in the way of keeping family wealth. But today's message is about that. It's about family wealth. It's not only about how to create it, but it's certainly about how to hold on to it. And on the right-hand side of your screen, if you have the visuals with us today, you'll see a book that I have been recommending for the last couple of years, Family Fortunes, How to Build a Family Fortune and How to Hold On to It for 100 Years by Bill and Will Bonner, friends of mine. And it's a tremendous read. So if you like reading, I wanted to make that recommendation. So what kind of families hold on to their money? You would think it would be most very, very wealthy families, but unfortunately it isn't. It's a very, very tiny percentage, as I said. But I wanted to use this particular family as an example. This is the Cargill-Macmillan family. They have 14 billionaires within their family, and they own America's largest private company. It's a $128 billion agribusiness. You're probably familiar with Cargill. And one of the amazing things about family wealth, it's really not the money that's the focus. It's the family creed, the family constitution, if you will, and the lessons that are taught within the family. For example, education, the knowledge base of how to work with money. Definitely experience. You don't get things handed to you in very wealthy families. You have to earn it. There's consumers and then there's producers, and in wealthy families they try to inspire you to become a producer and not a consumer. And then they particularly look for the best talent within the families, of course, to enhance and grow that family wealth exponentially, generation after generation. And of course, they have to go through the same things that all of us have to go through financially. They have to go through good times and bad times. And over the last recent few decades, particularly the last 3 decades, the 90s, the 2000s, and here we are into the 2010s, there have been 3 major boom type positions. One of them we're in right now, a very bubble-like period. And so how do these families hold on to their money when most investors seem to have a huge financial haircut when these crashes occur after the booms? So we're going to talk about that a little bit. We're going to start out by just, not really, this isn't a news flash, but I think for those of us that have been keeping our ear to the ground and our wits about us, it's quite obvious that America, let's put it nicely, she's not feeling too good right now. Actually, she's in some serious financial trouble. We all know the numbers. We see it in print every day. Eventually, with that kind of debt, the country is going to sink in the debt, and of course we're going to have a reset. Of course, the central planners and those that do all of the creative propping up will continue to do that, but eventually the day of reckoning has to come. And the reason I'm saying that is not because I want it to happen. The reason I'm saying that is because I remember it clearly and vividly happening in my home country of the UK when I was a youngster. We ran up terrific debt after World War I and World War II. And we had to start printing, and we actually abandoned the gold standard very early to help the country reinflate the economy. Some of these things are going to sound very familiar to you. A lot of the wealthy and the rich investors from the UK started moving their money to other parts of the world. Of course, inflation got completely out of control. We've seen the rates move up. Was that yesterday? And they'll continue to move up, and who knows what's going to happen with inflation. But the UK got into a terrible position. In fact, it went as high as 30%. In 1967, the gentleman smoking the pipe had the same name as my father, but my father wasn't the Prime Minister. This person was. This is Harold Wilson. He had a saying after he helped devalue pound sterling by 14%. One week it was 14% higher, the next week it was 14% lower. Can you imagine going into a store and having to pay 14% more for something that last week you paid 14% less? He said this won't affect the pound in your pocket. That was a big joke in the UK for quite some time, that everything affected the pound in the everyday man's pocket. We had terrible strikes, terrible strikes. And you can see on the bottom picture, trash filled the streets for months and months and months because people were just not working. So basically, this is what happened to the UK. It changed our society, in my opinion, forever. We've become more of a welfare state since. And no longer do they call it Great Britain. It's just England today. So what's going on here at home? Well, what's going on here in the US is everything starts with a T now when it comes to debt. Student debt, auto loan debt, mortgage debt, consumer debt. Household income is at a terrible number, $53,000 a year. It's the same as it was. Inflation, you know, adjusted for inflation, is 1989, a quarter of a century ago. And to add insult to injury, now inflation is starting to inch up a little bit. So who knows? Obviously, we don't want America to sink, and it's not going to go to zero. England didn't go to zero either. But the day-to-day life for the average person radically changed. So what's our message today? Well, our message is a positive one, actually, not a negative one. I know that was not too inspiring to start, but the message is a positive message. Maybe now isn't the time to panic, because of course we have a relatively young administration, and it seems like right now the stock market's doing really well and confidence is high. The funny thing about economies, though, is they don't kind of work via a set timetable or schedule. Crashes come oftentimes when most people are not even expecting it. So maybe now is not the time to panic, but it could be, and it might be the perfect time to focus more on loss avoidance and risk mitigation. Two words that the average investor probably has never even heard of. But I can tell you, the high net worth individual has those two words prominent and focused in their portfolio. The average investor, unfortunately, this is my opinion, and I'm a human being and I have an opinion, and we all do, and I think many times we think our opinion's correct. But I've studied this 60-40 model that has been the primary focus for average investors, maybe promoted too much by the financial institutions. But this 60-40 model, really over the last recent decades, 3 decades, has been a disastrous way to invest. Maybe the average investor has a few other assets in their portfolio. Maybe they have some real estate. Maybe they have a 401k, and maybe they've even, you know, bitten on this crazy buy gold and buy silver, which if you look at the charts, the long-term charts, it's a lousy place to invest. It's a great place. Listen, gold is a good place to store the value of your purchasing power. But with regards to investment potential and profits, you better be a high-risk player, because the real profits in that are in the mining business, and that's really a very high-risk place. Maybe you have a CD or something paying almost 1%, but the average investor is not very well diversified. They say they are, because they say, well, look, I have 60% of my portfolio in all these international stocks and in all these different companies. But that means 60% of your portfolio is in basically the same place. And that portfolio has had two things in common over the past 30 years. And the reason I use 30 years, because I know the financial world likes to talk in hundreds of years. But you and I don't invest for 100 years. The average person invests for 30 or 35 or 40 years. And so when we're thinking about our investments and growing, it's important to take note of what's happened most recently. It's important to take note of what's happened long term. But most recently, that type of portfolio has caused a lot of movement, a lot of volatility. And when you have volatility, as investors, we can't help ourselves. Some people think they can, and I would really question that, but panic sets in on both sides, on the upside and on the downside. When the markets are high, like they are now, and you hear the talking heads say it's going to go higher, you are encouraged to buy, and you go out and buy. And likewise on the downside, when things are crashing and all of a sudden, you know, the haircut's 50%, a lot of people emotionally sell, and that causes low returns. And what do I mean by that? Well, let me show you what I mean by that. Let's just take the last 3 bubble periods. Starting in 1999, there was a bubble right at the end of 1999. The next bubble was 2007, just before the 2008 crash. And I believe we're in a bubble now. And so let's take a look at what that looks like. So let's take a look at the Dow Jones Industrial and the NASDAQ and the S&P, December 31st, 1999. the Dow Jones Industrial was at 11,497. Well, here we are today, 17 years later, and it's hovering around 20,800. And so you think about that, you say, hey, that's quite a sizable growth. Well, it's actually 80% higher. It's 80% higher than it was 17 years ago. So 80% divided by 17 gives us a basic 4.7% annualized return in the Dow Jones. Listen, there's nothing wrong with 4.7. Yeah, it's better than 2.7 or 1.7. But if you're going to grow wealth exponentially, and you're going to grow wealth with low risk but high returns, which is a phrase which is really void in most circles of the investment world, because they believe, and rightly so, most high returns come when you add high risk. But there are asset classes that are very low risk that produce very high returns. They're the ones that the very wealthy focus on, and their portfolios are built around. The NASDAQ wasn't any different. The NASDAQ was 4,069. Today it's around 5,800, so that's a 42% jump, 2.4% in 17 years. The S&P likewise in the middle, about a 3.5% return per year over the past 17 years. Now, I don't know about you, but I can tell you, having an up and down portfolio and having it only 80% larger in the last 17 years, that's not too bad. But it could be a lot better. And so as you see, when something goes from 11,497 and loses 4,000, there's a pretty good chance that a lot of people are going to emotionally make the wrong decisions. Likewise, when it was 14,000 and dropped down to as low as 6, and here we are today. I used March the 1st because it was 21,115 on March the 1st. It's lower than that today. But I have no idea, and no one can really predict with any certainty whether it's going to continue to go higher so that we have an even greater crash, or whether it'll crash here soon. No one really knows. But that's not the message today. The message today is very different. And that is, take a look at those numbers. 11 down to 7. So that's a 4,000 plus drop. And then we had an 8,000 plus drop. And what if we have a 8 or 10,000 plus drop now? Who knows? It's just speculation. But here's what I know about the markets, and I think you do too, especially the stock markets. A lot of euphoric sort of statements and emotions that play around when there's bubble times. In 1999, I remember very clearly, because I had a financial planner at that time who was pressing me so much with his euphoric sort of phone calls on buying in to this .com, how it was going to change the financial world. Likewise, in 2007, we used to have card parties at my house and financial meetings. And some of my friends that had moved into the mortgage business were telling me that all of the safety gaps and safety mechanisms in the real estate world ensured that real estate was only ever going up. I mean, it was just kind of crazy stuff. And here we are today. I hear the same stuff on, TV and radio. And it was exactly the same in 1929. The euphoria was crazy. But after the crash, $14 billion was wiped out. And if we have a 1929 type crash again, I'm not saying it's going to be the same. I don't know. I know the decade of discontent was much longer than a decade in the UK after our big crash. And so maybe it's wise to think that, hey, I have to prepare my portfolio, because if there is a real big one, and if there is a real reset, 22 years it took the Dow to return back to the lofty levels of 1929 after its crash. I don't want to beat up on the stock market too much. That's because the stock market's a good place to be if you hold for 20, 30 years. It's not such a great place if you're a speculator and you hold for a few years at a time. But the stock market is, and I want to emphasize, it is a good place to be invested. I just don't think it's a good place to have 60% of one's portfolio. But I'm not a financial planner. I'm not a financial advisor, so don't take any advice from me. It's just a comment that I'm making based on the conversations I've had with others. Maybe you like real estate. I do. I like real estate too. But the median home price in 1999 was $172,000. I wonder what the median house price is in 2017. Well, there's the number right now. And this is, of course, across the U.S., so everyone has different numbers in various states and towns and cities. But all across the U.S. right now, $312,000. That means an 80% higher price than 1999. Once again, about stock market returns, which normally is not normal because the stock market, historically does better than real estate. But anyway, so my question is, what's your plan? If you have one at all. Maybe you don't have an answer. Maybe you do. I know a lot of people I speak to have goals. They call me up and they say, hey, I want to retire at this, or I want to be able to give my kids that, or I want to be able to travel. Those are goals. But a goal without a plan is nothing more than a wish. And so let's take a look at how very wealthy people approach investing. And here's two of them. Maybe you'll remember and you can recognize the guy on the right of the screen. And the guy on the left is in the same business as he's in on the right. They're both media moguls. You have Ted Turner on the right, and you have John Malone from Comcast on the left. And the reason I picked these two guys out is not because they're multi-billionaires. It's because they focus on loss avoidance. They focus on risk mitigation. And a large percentage of their portfolio is held in that stuff standing behind Ted Turner. Particularly, though, not just cattle and farmland, but in particular forests. They really love timber. In fact, both of them, between them, own about 6 million acres of timber in the U.S. And there's something about timber that I learned about when I backed into the industry now 13, 14 years ago. And I did back in the industry. He says, I didn't have the brains enough to figure all this out until I had one of my employees tell me about a piece of land that I purchased and how many trees it had on it and the value of those trees. Here's another couple of billionaires that you might recognize. Jack Ma, he's in the e-commerce business, and so is Jeff Bezos on the left, Amazon. They're both huge timber investors. And of course, they're also legacy investors, meaning they're thinking about beyond their own lifetime when it comes to the money that they create. They all have the same thing in common, these people. And it's not just individual investors. The one thing they love most is real assets. Not so much paper assets. Paper assets got them rich. But what keeps them rich is real assets. Dirt. And that dirt could be farmland, it could be, shopping malls, could be beautiful hotels and resorts, but real assets. We're going to talk about the one that has historically now, over the last 35, 40 years since it was tracked, outperformed every other asset class. Yes, I did say outperformed every other asset class. Timber. I didn't know timber it was even an asset class 14 years ago. I just knew timber was something that you build stuff with. Houses are built out of it, and beautiful desks. I'm sitting at my desk here in my office in Southern California. But all over the world, most of the timberland that exists is privately held. Families, not governments, privately held. Individuals, families, institutions, endowments. And of course, it's a renewable resource. And it particularly is fantastic for a portfolio because when the economy goes down, a tree couldn't care less. The volume of that log is going to continue to grow until it's harvested. And you harvest it, you have the great ability to cash it in when you want, not when the market says you have to, when you want. So timber is an amazing space, and I wanted to show you a chart. The green line is the NCREIF. NCREIF stands for the National Council of Real Estate Investment Fiduciaries. This one's the Timberland Index. They have other indexes in the real estate space. The green line is the NCREIF Timberland Index. The light blue line is global bonds. The yellow line is small cap American stocks. The blue line is global stocks. Red is real estate. I know a lot of real estate people are probably listening. Orange is emerging markets, and green is large cap. And so you can see the green line, and I took it all the way back to 87, and the chart here, I couldn't find a chart going further into 2017, but it stays pretty much the same. And the reason so is because the profits in timber are primarily generated from something that most portfolios never ever have the opportunity to profit from. And I'm talking about biological growth. You see, Warren Buffett said a long time ago, if the only way a portfolio makes money is by buying something at one price and then waiting to sell it to somebody else for a higher price so that you can make that gain, that's really not a very successful way to make money. Because markets go up, as you know, and markets go down. I want you to take a look at something, though. Look at 1999, right there where the green arrow is. That was when we were in that last bubble, and it crashed, didn't it, shortly thereafter. Look at the green line. And then the last crash we got was 2008. Let's take a look at that arrow. So here we have timber growing at an average of 14% per year, but in the bad, zigzaggy down cycles, it actually does really well. In 2008, for example, when the stock market lost almost 40% of its value, timber rose a little more than 9% that year. And you know, during the Great Depression, after the 29 crash, timber doubled in value. So it's a place for safety. And of course, if you know how to build a wealth preservation portfolio, your focus is on safety. Just another quick chart here showing large cap stocks, small cap stocks, international equities, also showing the standard deviation and the Sharpe ratio. The standard deviation, you want a lower standard deviation, you want a higher Sharpe ratio. And you'll see that timber averaged from 87 to 2008, 14.4%, while the average of the others were basically less than half. Of course, the standard deviation was where you want it to be in timber, and the Sharpe ratio was perfect. So let's talk about a win-win strategy, shall we? Because that's what the billionaire portfolios focus on. Not a win-lose strategy. The win-lose strategy, in Alex's opinion, is the 60-40 model. And what I mean by that is you win for a certain period and then you lose after the market crashes. And that's a tough way to build real wealth, especially wealth that's going to be passed along. So the first order of priority is low risk. Safety first. But you know what? They don't, that by taking on low risk, they don't want low return. These win-win strategies insist on high return too. And so that means they have to shop for specific asset classes that have low risk and high return. And so I want to share with you the four main pillars, the four main jobs of a wealth preservation, capital appreciation portfolio. And then ask yourself, when you finish this time with us tonight, how is your portfolio built? The first pillar, the first main job of a portfolio like that is risk reduction. You all know, like I do, that when you lose 50% of something, it takes a 100% gain to get even. That's not easy to do, and it generally wastes time coming back. You just saw the stock market go up and down every 7, 8, 9, 10 years. Wasted time. The second job of a wealth building portfolio is inflation protected income. Income coming in consistently that beats inflation. The third pillar, the third job is long-term growth enhancement. Making sure that the assets that you put inside the portfolio grow long-term. Not short-term speculation, which is what I believe most investors are trying to do today. Find that deal, find that real estate house that they can renovate and flip, or which is the next potential greatest IPO, or can I take a chance on this oil well that looks like it's going to be drilled in a field where there were other successful oil wells. So number 3 is long-term growth enhancement. And then the fourth main job, the fourth pillar, is purchasing power protection. And those are the 4 things that the super wealthy, and it's not just individuals, we're going to get to that. Imagine those 4 pillars, protecting that family legacy. Most investors have a plan that's completely void of these principles, and consequently that's why the average 65-year-old in the US retires with less than $250,000. Got to stay ahead of this declining dollar of ours. We all know that the dollar is absolutely worthless, and fortunately it is the legal tender currently, and it's propped up and it's printed every day. And if we do have another massive crash, you can bet your bottom dollar they'll announce QE4, making it once again less valuable than it is, the dollar. Oh, one thing about the market that I was kind of fascinated to find out the other day, that these 4 stocks, these 4 companies, for those of you that are in the stock market, collective value of more than $1.5 trillion. Of course, these prices, they only make sense in a bubble. Of course, they won't make sense in normal conditions. I don't know how earnings will ever catch up with some of these companies, but just those 4 stocks alone, they've represented half of the entire gain from the stock market over the last year. Just those 4 companies. So could you imagine when the market starts to inch over the edge, one of them falls, 2 of them, and of course they're not going out of business, but I'm talking about the share price now. Kind of dangerous to think. So ask yourself a question tonight, would you? What type of investor are you? Are you a short-term buy and sell profit seeker? Are you constantly looking for deals every 6 months, every year? Are you working with people that have relatively short time frames? I have a friend of mine that told me the other day he was happy to be able to call a client because a client made 30% annualized over a two-month period. So, and hopefully he'll reinvest. A lot of people forget that when you make a nice return and you make it in 2 months, depending on which state you live in, that 30% return is down to 15% in California. Anyway, long-term, are you a short-term investor or are you a long-term wealth builder? Do you take out the mortar and the trough, and are you building a wall of fortune around your portfolio for you, your kids, your grandkids? I know that Jim Rogers is doing that. He's teaching his girls and has been teaching his girls for years about agriculture. He says agriculture is going to be the next big thing, especially over the next 20 years. Kind of joked. He said farmers are going to be driving Lamborghinis and stockbrokers are going to be driving taxis. He's kind of a character. So let's just take a look. Here's a couple of families. On the left is the Cargill family. It's a big family. Someone was getting married that day. And then on the right, that's the Turner family. Of course, we all have to put our kids through education. I'm going through that now with college. And so what steps are you taking to ensure the financial legacy of your family? Just a question I'd like to pose to you. A great way to drive portfolios forward are alternative assets. In fact, alternative assets have driven the world's best performing portfolios the last 25, 30 years. Hasn't been the traditional assets that we're all familiar with, that are peddled and advertised and you can trade for $4.95 each time. It's alternative assets that have driven the best performing portfolios. I'm talking portfolios that didn't see massive haircuts. And of course, in center stage is timber, and particularly the timber that's on the screen, which is rare, valuable, precious hardwoods. We're not talking 2x4s, plywood, particle board. We're not talking paper and pulp. We're talking very valuable hardwoods. Jeremy Grantham runs the GMO fund, $120 billion fund. And he said in a newsletter, timber is the only low-risk, high-return asset. And in his opinion, it's the best long-term investment, period. He's been investing in timber all his life. Most investors, of course, they're going to look at you as though you've gone crazy investing in trees. Only one in maybe 10,000 own timber. And there's various ways to own it. Of course, you could buy a REIT. You could buy shares of a publicly traded company. That's not really a pure play. The gentlemen that I've shared with you today are pure players. They want the dirt. They want the trees. Because the stock market can go up and down, and a REIT can play funny games, because most of the REITs in any event here are real estate plays in the U.S., the timber REITs. But if you're going to own timber, the best way to own it is fee simple. It's not just the billionaires, it's the billionaire funds, or in this particular slide, the endowments and the institutions. In 2008, when the market crashed, Yale did not see a huge disparity or did not experience a huge loss to their portfolio. The reason? They only had 6% exposure to the stock market. Unfortunately, Harvard was not managed that way. Yale had lots and lots of money in timber. Harvard lost almost 1/3 of their endowment's value. They lost over $10 billion. And quickly did they take a turnaround, and in fact the manager of the fund was fired, of the endowment was fired, and they hired Jane Mandello, and she immediately moved into natural resources, bought 280,000 acres of timber in Brazil and Romania and other parts of the world. Thankfully, on her move, Harvard's backing it up to 30 billion plus today. There's other alternatives too. I just don't want to keep pounding on timber, but there's lots of other alternatives that I wanted to share with you. Private equity, of course, leverage financing, sponsor credit, venture capital, mezzanine financing, master limited partnerships. I mean, you can Google all of these things. Catastrophe bonds, peer-to-peer lending, managed futures. There's lots and lots and lots of, find a good financial planner that understands alternative assets. We diversified into coconuts a few years ago. I call the coconut tree a perpetual income producer. Most people call it a palm tree. To me, I look at it and it's actually an agricultural annuity. I know a lot of people in the U.S. Buy a lot of annuities. In fact, funny thing was today I got an email from Fisher Investments the 19 reasons to avoid annuities. I don't know. I don't have an annuity. I probably won't be buying an annuity. An annuity, in my limited knowledge, is something that you own until you die. And you give them all this money and they pay you 4 or 5 or 6%. Why would you ever do that when you can own a whole bunch of coconut trees that don't care about anything other than making coconuts? And I can get at least double the return, and it lasts not just for my lifetime, but they produce for the next 60 or 70 years. And it's just my opinion. We're not a sales organization. We don't use sales techniques, but we do educate. And there are alternative assets that can outperform the traditional ones that everyone that comes to your house for the birthday party or for the Christmas celebration invests in pretty much the same stuff. Think outside of the box sometimes. Another perpetual income producer is the coffee tree. We've diversified into coffee in 2017. Coffee is the second most globally traded commodity on the planet after crude oil. And there's an insatiable appetite for coffee right now, not just here in America because of the millennials drinking so much, but also in India, where, of course, for centuries tea has been the primary drink, and also in the Asian communities it was tea, and now it's moving to coffee. So the small region between Capricorn and Cancer, where Nicaragua is positioned, and Central America, because a lot of coffee that does travel across the world is grown in Central America. America is the largest consumer of coffee in the world. We don't grow any coffee beans in America. We're not in the right region. And so that's another perpetual income producer, is to own some coffee trees. We've looked at other assets, by the way, in this space. They're just too risky for us, what I call the high-risk perishables. For wealth preservation investors, they kind of stay away from the perishables. And so let's just quickly surmise. To reduce the portfolio risk, that is pillar number one. To protect the purchasing power. To make sure that the portfolio produces inflation-protected income. And you achieve long-term growth. I mean, those are the four main pillars. Our operation has two ownership positions in this space that we work in. Fee simple land ownership. A lot of our clients like to own the dirt too, because not only are you seeing the commodities give you a return on investment, but land appreciates. And of course, when you look at the global population increase, there's more and more people every year. There's less and less arable land, and in Nicaragua particularly, very few people know this. Nicaragua sits on the 6th largest freshwater aquifer in the world, and now everybody that's been following Nicaragua for the past 29 years, since it's became a democratic republic, the prices of farmland are starting to move up. We also have a U.S. domiciled investment fund, and the fund is a triple blended fund, so investors that buy into our fund automatically own coconuts, timber, and coffee. So I would recommend, before I pass this over to Alan, my friend and business partner here the last year, with a tremendous financial background, but I would just recommend find a really good financial planner, especially one that works with alternative assets and investments. I personally like the fee-only type investment advisor, financial advisor. Maybe you're an old curmudgeon like me that likes to do your own research. You like to take time to do your own education. You think, and choose wisely. But I wanted to share with you just those things, that wealth preservation, wealth capital appreciation is not just a matter of, a bunch of stocks in different countries and different, uncorrelated industries. and then some safety because they want to sell you some bonds, or they tell you to put some money in a CD. There are better ways the last 30 years, and I don't know about you. I like the better way. So Alan, I want to pass it on to you to share, if you will, just a little bit of your experience with us and how you got to know us, because you're heading up this this tremendous fund that you've put together.
Absolutely. Can everyone hear me well?
We can.
Great, 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 great. So about a year ago, I met Alex Wilson. Alex is a great presenter. Here in the webinar, I'm sure that he's impressed upon you, his presentation abilities and his knowledge. I had the opportunity of seeing him live. I was interested in real estate in Nicaragua, luxury real estate. I'm in real estate. I'm invested in real estate. I'm not a paper asset, but I like tangible assets. So that was attractive to me. And at some point, Alex had the opportunity of presenting precious timber, and as a trained economist, what he was saying was resonating with a lot of the things that I had been reading. But what was flashing through my mind as he was talking were my kids. I'll be very honest with you. That's the reason why we all work, and we work very hard. And the things that he was talking about were very appealing to me. So I decided to take a very close look, and it took me about a year of looking into things and looking into the company to decide that this was something that I was serious about. And I approached Alex, and I went down to Nicaragua, and the more I looked at it, the more I thought about it, the more my kids kept flashing in my head. And so Alex and I, Precious Timber, myself, and Alex, we share common values, common philosophies, and we decided that Alex was talking to me while we were in Nicaragua, and he was telling me that some of his investors were interested in the idea of investing in a U.S. company, right, versus owning land in Nicaragua. So we decided to look into the legalities and things of putting together a land syndication. In this particular case, it's an agricultural land syndication. Syndication is the pooling of resources for the accomplishment of a common purpose. In this particular case, we have formed a fully managed company that grows, harvests, and sells a blend of trees, coconuts, and coffee. So with this fund, you don't lose Alex Wilson. You gain the principles of the fund. This private U.S. agri-fund is a $20 million fund available to accredited investors only who seek long-term income, long-term capital appreciation, and long-term capital preservation. The fund will acquire close to 1,800 acres of productive farmland. The principles and values, as I was talking about, which are people, planet, and profit, are in the DNA of the fund. Precious Timber will continue to select where we plant, what we plant, and will continue to manage. And what we've decided to do with those acres in order to maximize the fund is to plant 1,000 acres worth of tropical hardwoods, because that's where the highest returns are, 600 acres of coconuts, and 172 acres of coffee. The reason for the blend is that Coffee sales begin in year 2. Once you plant coffee, you begin to yield in year 2. So your sales begin then and continue throughout the 20 years of the fund. Then you have coconut sales begin in year 4, whereas timber sales begin in year 12. This combination, based on conservative projections that we put together, is projected to yield 8 times the return on investment. That's an 800% return. Going to the next slide, the dividends in the fund will be increasingly greater as time goes by, and the fund holdings experience what Alex calls, and you'll realize it's called biological growth. In other words, you plant things and then nature takes root and things begin to grow. So that in year 2, the coffee begins to yield. Then the added dividends of the sales of coconuts begin in year 4. So those are 2 layers of income, and then the third layer of income begins in year 12 with trees. The fund will experience, it's projected to experience superior long-term, that's how it's built, risk-adjusted returns, which are a factor of 2 things, capital appreciation and capital preservation. The triple bottom line investing, people, planet, and profit, also known as impact investing, because you're impacting society and you're having environmental impact, is an investment approach with the intention to generate financial returns along measurable impacts. Since the term was coined, increased investor and consumer participation in impact investing has taken place over time. Consumers are increasingly demanding these types of products. Think green revolution, pesticide-free organic, so that investors in 2009 were participating to the tune of about 50 billion. We saw a great uptick just a few years later, 2014, with $500 billion of investor participation in impact investing. And the projection for 2020 is $1 trillion that are projected or estimated to yield $667 billion in profits. The yin and yang in this type of opportunity is strong investor performance and a positive environmental and social impact. So as you can see, it's very attractive, not only from a dollars and cents, but from an environmental and social impact perspective. Terrafort.org is where you can go to find out more about the partnership, the problem that we're resolving, the solution that we found. What the global environment is, the opportunity for you, and please make sure to join our blog.
Thank you, Alan. I appreciate that, and I just want to make sure that everyone tonight understands it's Alan that's the economist and not Alex. Alex is the farmer. So let's just finish up and see if Kevin has some questions that people have posted. If you want to post a question in the bottom right-hand side of the webinar screen, there should be a space, or you can email Kevin right now at kbird@precioustimber.com. But look, let me just point out one or two quick things to finish up. Our global population continues to expand, of course. And let's just go back to my scenario here of the 3 bubble cycles that we've been in over the last 3 decades. 1999 was the first bubble that I mentioned. And in 1999, there were 6 billion people using timber, 6 billion people drinking, or maybe a percentage of the 6 billion people drinking coffee and using coconut-related products. And so that's grown since. 17 years later, here we are in 2017. Our business hasn't gotten smaller. The demand on the products that we grow hasn't gotten less. Right now, there's 7.5 billion people on the planet. And so if we look ahead, and we look ahead to the life of this fund that Alan has so tremendously put together, In 2035, there'll be 8.8, almost 9 billion people on the planet using these commodities. And by the way, here in the U.S., every single one of you and every single person in the U.S. uses the equivalent of one 100-foot tree every single year. So if you recall my my 17-year returns, 4.7, 2.4, 3.5 from the stock market, ask yourself a question. How will your portfolio grow during the next 17 years? Think about your age right now and where you'll be 17 years from now. And if you're listening and you're in your 30s, I'm kind of envious because I didn't learn about this until well into my 40s. And when I learned about it, my dad was in his 90s, and I remember him telling me, boy, I wish I'd have learned that when I was in my 40s. You're learning about it now in your 30s, 40s, 50s, and 60s, and 17 years from now will pass quickly. And so how's that portfolio of yours going to grow, especially when you know that there's going to be up and down times? What will drive the profits in your portfolio? Will it be biology? Will it be Mother Nature? Quite frankly, I think Mother Nature does better than Wall Street. And so if you'd like to experience biological profits, profits that grow because of just, you know, the natural God-given planet that we're on, you know, things grow, you stick them in the ground, you have experienced and qualified people take care of them. And of course, you'll see, you can see from the asset classes that we're in, we're not in the high-risk spaces. We're in the low-risk spaces and the non-perishable items. They also protect your portfolio. They're loss avoidance assets. So in other words, when the other side of your portfolio is zigging and zagging, because you don't want all of your eggs in one basket, but when the high-risk side of your portfolio is zigging and zagging, these asset classes act as stabilizers. And then finally, of course, they produce inflation-protected income. They produce income, some of them every year, and timber, of course, periodically when it's harvest time. It's tough if you're a 60-40 and you've been in this 60-40 model for 30 or 40 years and trying to get out of it. I know it's not easy. It's you know, trying to be different. But sometimes you have to change. You know, you have to get out of that shell and open those wings and look at things. Don't do it without a good education. Open that mind a little bit. The mind's like a parachute. Doesn't really work if it isn't open. That was our good friend Frank Zappa. Think outside the box a little. These are times for us to think a little bit outside of the box. Our company focuses on education, not on selling. If you've ever worked with us, spoken to us like this gentleman on the screen, one of our clients, do your own due diligence. Come down, come into our workshop, come see us make some of the furniture that we make, come see the harvesting, come see the planting, come see the hundreds and hundreds of employees that we have, come see the nurseries, how everything's taken care of at the nursery. You know, ask us for lots of information. We've got a plethora of information for you to do any kind of in-depth research and build that knowledge. You can look at it on our website at PreciousTimberProfits.com and request various white pages, PreciousTimberProfits.com. If you're more attracted to coconuts, then go to ProfitsInCoconuts.com. Go to our YouTube page, YouTube Precious Timber, and there's lots and lots of webinars and articles and various things there. Request our free white papers by getting on our website. Email us, you know, some information, and we're going to have a new email education series start soon where we'll be asking those interested in subscribing to that, where we can send out information periodically via email. Or you can get on the phone with myself or Kevin or Alan and have a personal one-on-one consultation. You can even call us. Numbers on the screen. And this recording will be played, be on our website within the next 24 hours. The best of best is get on the plane, join us on one of our timber and coconut and now coffee discovery tours. Come see the plantations. Come do what Alan did. Come touch it, feel it, come talk to the engineers, come talk to the foresters, come talk to all the staff. It's a fun weekend out. You don't have to take very much time. It's a very close place. 2 hours from Miami. It's 3 hours from Houston. It's 5 hours from Los Angeles. Jump on a plane. When you're there, we'll pick you up. We'll take care of all of the ground transportation. You'll have a good time if nothing else. I know one thing, you'll come back and you'll say, oh my gosh, I did not expect Nicaragua to be like that. Nicaragua today is not the Nicaragua of 1979. It's a flourishing, growing economy with 5.1% GDP growth since 2008. It's actually now, according to the World Trade, the World Bank and the IMF, it's the safest Latin American country on the planet. Nicaragua, the safest Latin American country, safer than Costa Rica. A lot of people go to Mexico. Let me tell you, Nicaragua's way safer than Mexico. Our next Discovery Tour is June 3 and 4, and then they will on the weekend after. We limit them to 12 guests only, 12 guests or 12 clients at a time, accredited investors only. Kevin, let's finish up.
Yes.
We're 4 minutes over than I expected, so do we have any questions that were posted that I can try to answer?
Yes. Can you hear me okay?
I can.
Perfect. Yeah, actually, a couple of the questions stood out to me because they're probably the most common questions that I would get asked talking to folks. The first one is probably an easy one for you to answer, and that's really what kind of people can invest with us? Are there any particular requirements, anything that's necessary for them to join us?
The land side of the business is a straightforward land transaction, so most anyone that wants to join us in the land side of the transaction, of course, we have to have proof of funds first, but our plots start as little as $100,000 for 6 acres of coconuts or 5 acres of timber. On the fund side, you do have to be an accredited investor. The SEC here, under the 506C Regulation D format that Alan has built the fund, you do have to be an accredited investor, so we will need qualification, proof that you are an accredited investor. An accredited investor is someone that has a annualized income of $200,000, has had it for a few years, expects to have it in the coming years, or has an investable net worth separate of their primary residence of $1 million. So those are the two real requirements. Other than that, you know, you better have a strong interest, because we're not the kind of company that takes on clients that are short-term speculators. This is a long-term wealth preservation, wealth capital appreciation space. So you really have to fit, because when you join us, you help us create a lot of jobs, a lot of meaningful jobs, and we are very focused on the local community and the social impact that we make, likewise with the environmental impact and the new wildlife corridors that we create. So we do like to work with people that have the same kind of you know, feelings towards making money. Money is, you know, I often say money's only buys the things that money can buy. It's important to have it, and the more, it's better to have more than less. But we do make an impact, and if you're the kind of investor that likes to make an impact in addition to making money, that's a perfect fit for us.
Excellent. And then the other question, which seems very simple on the surface, but I know from experience it's got a lot of depth in the way that you might answer this. But the question was, so what's the main differences between, what are the main differences between coconuts and timber from the point of view of the investor? How might they decipher what might work better for them?
Well, of course, if you're going into the fund, you're getting all benefits of all three. But if you're purchasing the fee simple owned property, the main difference, of course, is coconuts produce coconuts in their 4th year generally, even though our 3-year-old trees are already producing nuts now. And so it's an annualized payback. They continue for many, many years. The ROI per annual basis is less than timber, because timber grows exponentially. Of course, its volume of growth from a tiny sapling to a log is quite sizable. Of course, you can harvest any time you want with timber. They're your trees on your land. But if you really want to get, if you want to make an investment that's going to be almost like I call it like a crazy lottery winnings return, because the ROI on these tropical timbers, if you can wait 10, 12, 15, 18 years to harvest some of these trees, it's a tremendous wealth builder. So the main difference is one's an income producer. The nuts have to come off every single year. You can't leave them to grow bigger. They just don't. They rot and they fall off. Whereas a timber tree, an African mahogany, for example, you want to wait a little bit. The longer you can wait, the greater the return will be.
Excellent. And that's a good way to finish it, I think.
Well, if you have any other questions, email Kevin at kbird@precious-timber.com, or email myself, awilson@precious-timber.com. I do appreciate everyone hanging out. It seems like a lot of people hung out. In fact, we had more people come on over the last 15 to 20 minutes. But once again, appreciate your time. Focus on thinking outside of the box. Watch this market. Be prepared. Get yourself some loss avoidance and some risk mitigation strategies built in, and you'll be able to weather any kind of financial storms. Have a great evening. We do appreciate you sharing the night with us. Good night.